Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Mr. Frederic Lasserre, Gunvor Global Head of Research and Analysis. Frederic, thank you so much for joining us today.
Thank you for having me.
Well, a lot to catch up on the markets. Let's start with just asking you about, your sentiment on where we are. Now we're sort of about to enter the fourth quarter of the year. It's been a dynamic year in every sense in terms of macro, geopolitics. But the oil price, although it has weakened throughout the year from its highs, has remained relatively stable despite a lot of uncertainty to come, tariffs, you name it. The question marks are out there. What would you say is holding, at least the last few weeks, the price in the range that it's been in?
Well, I guess two kind of factors explain this pretty robust market, despite the fundamental outlook, which is quite gloomy, I would say. I think that on one side, we had still a pretty tight crude market on the prompt. Very prompt was still tight.
Yes.
And the other component is obviously geopolitics. I guess that there is a large consensus within the market to expect that there should be some more geopolitics by the end of the year. Would be either on the more sanctions on Russia or potentially also with Iran. So on one side, the outlook is pretty bearish. So I guess some market participants may be tempted to express this bearishness via short positions. But at the same time, they fear that in the meantime, before we see this stock build on crude, we might see some price spikes because of geopolitics.
Okay, I mean, let's just stick to the geopolitics point. You mentioned Iran, the activities we had in June, which should have rocked certainly the prices a lot. But, we've had this sort of slightly sort of laissez-faire, relaxed market in terms of, well, if there's no physical disruption to supplies, and we haven't really seen that even with sanctions on Russia, even with everything that's been happening in the Gulf in the last year or two, and with the Gaza situation and with, proxies reacting to that in the region, traders are now saying, it's all the same really. We're not going to see disruption to flows. We've had shipping routes change, but really, until we see that, we won't. But what would you say the recent attack on Qatar last week has made markets a bit more nervous? Because that is a slight turn on the physical front, isn't it?
Yes, I guess the market turned a bit more nervous because actually we all understand that we end up the 12-day war without any conclusion, any concrete settlement, agreement with Iran. Iran is sticking with its red lines, maximalist demand, no compromise on the inspection of the nuclear facilities. And therefore, the market feel that there might be some more action regarding Iran because Israel is unhappy with the situation, uncomfortable. This is far from over. And looks like, again, the negotiations are not going anywhere. So again, that's part of the risk premium that we feel we still have in the marketplace because of these potential actions on Iran, also maybe because of sanctions on Russia. But globally speaking, Iran is still in sort of gray area where we're not sure about what to expect for the months to come.
Okay, and what about then? Let's talk about what is perhaps more predictable or under control, which is, normal supply. Let's say OPEC plus decisions on what they're supplying into the market, the comments in the last few weeks again have been, as you said, there's a bearish tone. There's plenty of supply. There's tight fundamentals short term, but there's plenty of capacity. How much of a part has China played in, again, absorbing that supply? Because there's been quite some interesting figures there, haven't there, in terms of it's beefing up its storage on that front, hasn't it? Has that lent, do you think, how many dollars has that lent to the oil price?
Difficult to put a number, but clearly China has played a role in absorbing some of the surplus that we've seen already in the market. Actually, was one of the most discussed topic within APEC. So how much China has already absorbed and how much China is willing to absorb over the coming months. That might be one of the solver of the big surplus that everyone is expecting for H1 next year. Actually, the trend is a bit bizarre because it started all in March when China started to stockpile crude at a very impressive rate, close to 1 million barrels per day. Then it slowed down quite significantly. June, July, August, we are only around 300 kbd. So there is a big question mark on how big could be this stockpiling for early next year. Should they be back to 1 million? Will they stick to 300 kbd only? Makes a big difference on the potential impact on prices because, as we know, all that crude which is moved into tanks in China, whether it's CPR or SPR, doesn't make any big difference in the end. The key element is that you remove the surplus from the pricing centers, and therefore you don't have any much pressure on Brent, Dubai, TI curves, and that's the key element for the marketplace. So again, big question mark, how much China is willing to stockpile. Looks like there is two key elements to have in mind. One, looks like China accelerated the stockpile when prices were below 65 on the Brent basis. So there might be a price incentive in this rate at which they're willing to stockpile. And also looks like they have stockpiled much more during maintenance season on the refineries, just like they maintain crude imports despite the fact that runs were slowing down. So maybe early next year, when again comes back the maintenance period, we should expect to see China taking much more crude than we've seen recently.
Okay. And I mean, would you say that playing into that sort of market balance, if you like, OPEC volumes, let's just talk a bit about that. We had an announcement from them a week or more ago that they are planning to now, continue to add from October, okay, one amount they specified, and of course that's subject to change always. But do you feel what do you think that signals from OPEC's side? Is it a confidence that demand is still okay? We do see some divergence in the outlooks there between different agencies, or is it, do you think, let's keep grabbing what we can of market share at these prices because the tone is bearish going forward?
I guess there is a mix between first, you're right. I think that the Saudis are pretty confident that demand for crude will be probably better than the consensus for Q1, Q2 next year. And in particular, because I think that they assume that indeed China is willing to take any incremental supply from the Gulf, from Saudi Arabia, UAE. That's one element. The second element is that even if you believe in this very bearish outlook where we're heading for surplus on crude, Saudi Arabia feels that anyway, as part of this unwinding of the cuts, they are almost the only one being able to increase supply. So they have the full control on how much incremental barrels they will put on the market. They already said that they will be very flexible. They can go for 3 times the monthly increase if they feel demand is okay. They can also make a pause and postpone for 2 months, 3 months, if on the opposite, they feel that the market is a bit heavy. So they're not so super worried on adding too much on the surplus because, again, they have the full control on how much extra barrels they're going to put on the market.
Okay. Let's talk a bit about, Frederic, about the US and the US economy. Of course, we've got, the interest rates going to move down very soon. That's the majority of expectations would say once, twice, 3 times maybe before the end of the year. Donald Trump has so far is getting his way in that. Of course, that boosts liquidity into all assets, but oil. And do you think oil will benefit from that in terms of having a boost, or will it catch up with other things like Bitcoin and equities and gold?
I'm not so sure that oil will benefit because there might be an impact on equities. Although, when the Fed is cutting too much, sometimes the message is quite the opposite because the market feels that, oh, they know something about the economy that we don't know, like it's more worried than we thought. So be careful about that.
Yes.
And two, the other element is it's still a big unknown on how much tariff would impact the US growth and the rest of the world growth, actually. I was quite surprised when looking at the consensus regarding oil demand growth for next year that for most forecasters, they do expect a better growth next year than this year, although in terms of economic GDP forecast, they're all being cut like 1/10, 2/10 here and there. So normally you should get lower growth, not better
Yeah, of
growth.
course.
And just like the market is a bit complacent on the fact that no one is expecting any sort of impact on tariff on economic growth and therefore on oil demand. which is, again, maybe a bit complacent, I would say.
Yeah, I mean, you could argue we haven't seen too much economic impact yet when you talk about Asia as well, especially China demand, etc. Of course, there's been hesitancy and sentiment impact, but that's why everyone's saying really come fourth quarter, that's when we're really going to see it impact, not just, the companies, the countries being tariffed by the US, but the US economy itself, because of course that's all going to slap back, isn't it, to the corporate's cost on, and on the street cost, if you like, regardless of what equities are doing. So that's perhaps still to come.
Yes, indeed. I feel that indeed it was a bit too early to expect any visible impact from tariffs. On the opposite, what we've seen since the beginning of this tariff sequence, I would say, was more a positive impact on some countries in terms of industrial demand and exports, because we have seen some tariff front running from US importers. So on the opposite, this has boosted a bit. In particular, in China, it was quite clear in
Yeah.
Q2 we had some definitive clear impact coming from US importers importing much more than usual to, again, front run the tariff. Now this is over. Looks like we're going to come to an end. On the opposite, we may get another sequence on tariff as part of the secondary sanctions on maybe China and or India because of Russian crude. So who knows? There might be incremental tariffs to come for China and India, and then the impact again still remain to be seen. But just if you keep in mind that the average US tariff in 2024 were 2.3%. Now they're 16%. Honestly, I doubt that you can multiply by 8 the tariff without any sort of impact
Yeah.
on economic growth, oil demand, inflation. I doubt seriously.
Absolutely. And how do you think Europe will fare compared to Asia? I mean, we've talked a bit about touch on China and India. Of course, India continuing to take Russian crude despite the sort of extra tariff threat from the US on that. Donald Trump playing games with his Russian roulette, if you like, 1 minute helping Putin, the next not. But should Europe be very nervous, do you think, about tariffs? And again, how is that going to impact industrial activity? And obviously that will reflect in oil demand.
I think, globally speaking, Europe should be in a better position than maybe China because, on average, tariffs imposed by the US are lower. However, there is clearly some sectors. Obviously, the automakers sector in Germany is very much exposed and at risk. And we've seen already some potential impact in terms of lack of investment, layout, and so on. So, yeah, there might be some sectors suffering a lot in Europe. Globally, we should suffer less than China if tariffs remain around the current level. But the point was also that the growth in Europe was already weaker than in China. So pretty much this is not painting a very rosy outlook for Europe in terms of economic growth for next year.
What about gas? And let's touch on gas and gas. As we get into winter, Europe is always a little bit vulnerable. It's really got its act together the last few years, easing off a little bit on pipeline Russian gas, and of course, switching to US LNG. It's tied itself in also to take on more LNG at great cost. And vow to sort of leave Russian energy altogether within 2, 3 years. The US is obviously pushing for that. I mean, do you think that Europe is going to continue to have a good control over that as it manages its consumption needs as winter approaches, etc., or is it vulnerable?
I think it is vulnerable. I was honestly quite surprised by the deal that the EU signed with the US in terms of tariff. As part of this deal, we have a strong commitment to increase a lot our procurement of US gas with some numbers which are quite unrealistic, I would
Yes.
say, in terms of amount, in terms of dollars, volumes, and so on. I'm not even sure that the US can provide that kind of volume to Europe. So there was a clear element that maybe everyone has been a bit overly excited, optimistic about this deal. However, I think that vis-à-vis Russia, it's going to come to an end. No doubt that the negotiation with Russia apparently are going nowhere as well. There is no
Absolutely.
compromise on Ukraine. Putin is not only sticking to his maximalist demand, but even increasing them, right? Asking EU to recognize officially that the invaded territories are now fully part of Russia. This won't be the case. EU cannot accept that for sure. So there is no other alternative but to cut the links as much as you can. However, again, Europe is very vulnerable, not only on gas, but same is true on some refined product. Same is
Yeah.
true on crude. We're still importing some crude via Druzhba South for some landlocked refineries in Europe. And again, we have no plan B. That's the reality, right? So yes, we are very exposed, and maybe we are a bit too ambitious in terms of what we can do in terms of potential sanctions on both gas and oil.
Yeah, absolutely. And the other, of course, sector that has been impacted a lot by sanctions, by geopolitics, is shipping, of course, and transit traffic and cost, rerouting of a lot of oil and oil products as well. In the last 2, 3 years, that's nothing new, but again, that remains the case. Does how much attention do traders pay to that now in terms of the vulnerability of rerouting because of geopolitics? Or again, is that all settled now, and we have some established new patterns and predictable costs as a result?
It has not really settled. Actually, it did settle after all the rerouting has been managed, allocated, and so on. But this has increased clearly the freight cost, definitely. And now we see a sort of second impact coming from the fact that we have this increase in crude supply, both coming from non-OPEC, which is Atlantic Basin. It's coming only from
Yeah.
the Americas, so Canada, US, Guyana, Brazil. And at the very same time, an increase coming from potentially OPEC remain to be seen, but it's already the case for UAE and so on. So we have both a much stronger demand for VLCCs, Suezmax everywhere, in a context where the fleet is already doing some longer journeys, and therefore it's very tight in terms of availability of vessels and tankers, and this is reflected in much higher rate in terms of shipping. So the cost for the landed barrel is increasing for sure.
Okay. Frederic, I mean, just to, again, big picture question. We've talked about OPEC supply and obviously demand, economic outlook. The price of oil has remained in the 60s, and the argument for US production on where the break-even comfort level, if you like, stands. A lot of people saying until, US production won't be impacted until or unless oil hits 50, and that's when low-cost producers will gain advantage in terms of market share. US oil production looking pretty static this year, neither up too much or down. Is there any sentiment around that or any worry by the market that if that begins to retreat more next year, that we will see some different dynamics in the market now as the biggest sort of producer in the world?
Well, I guess that one element to keep in mind is that the US oil production, globally speaking, not only shale, but globally speaking, is less and less price sensitive
Yeah.
compared to what it used to be years ago. That's coming from, on one side, productivity gains for the shale. We feel that the marginal cost is lower and lower, so they are less exposed to the price drop, or at least you need to go even lower to have some significant impact on the US supply. And also the fact that when you look at recently, more of the growth is more coming now from the Gulf of Mexico, Americas, which are not price sensitive. It's typical conventional offshore type of
Yeah.
project. So we don't think that the one solver for the potential surplus that we all expect for early next year could come from the US supply. You will need to have a massive price drop on WTI. And point number two is the time lag should be anywhere between 6 to 9 months. But that would be even too late anyway if we get this price drop by the end of the year to see the impact on the first half of the year outlook. And last but not least, what we've seen over the last 6 months is that each time we had a price spike, and we had some regularly, we have seen a flow of hedges coming from the US producers trying to benefit from those price spike, while they were already aware that the outlook for next year was pretty gloomy, pretty bearish.
Okay, I mean, just to flip back to Asia and to China, we started the conversation by talking about, China absorbing a lot of the supply that's been coming on, much more this year than usual, whether and some agreement or disagreement on how long that can go into next year. I mean, what about the aspect of China where there's no doubt it's sort of galloping ahead with its electrification agenda, energy transition, cars, obviously battery cars, etc. And LNG trucking. I mean, a lot of electrification and sort of cleaner fuel agendas there. Is that a concern for, do you think, for the oil industry? Is that something that is still surprising those who are trying to forecast what demand support can be brought from there?
It is a concern for the demand outlook for sure. We feel that diesel demand in China is already contracting. So we have passed the peak for sure. Gasoline is broadly flat, but we expect next year to be the first year we're going to see some visible demand decline for gasoline in China. So yes, the demand outlook is not pretty positive for core refined product, although the naphtha demand, LPG demand should continue to remain quite robust, thanks to the new capacity for the petchem complex. There is also
that's going to be the savior for crude, isn't it? Really, petchems. I mean, that is the.
You don't have that much refined product to feed the petchem complex. A bit of naphtha, but LPG is not really coming from crude, so it's not so clear. But there's also a supply element in this Chinese demand story because precisely to continue to produce naphtha, the US refiners will also produce mechanically gasoline and diesel, and they feel that demand is contracting, the domestic margins are not great, and they can't export as much as they want because of the quota mechanism. And we understand that they're trying to lobby a bit the government to get more quotas next year to get rid of this potential surplus of gasoline and diesel they're going to produce. And therefore, you might see more exports from China on road fuels, and that may have an impact on the market as well.
Absolutely. And I mean, but Frederic, just to kind of wrap up back to Europe again, and we're taking you around the world now. But as we're talking about refined products, I mean, Europe, of course, the trend recently has been, obviously refineries shutting gradually as the shift, these big mega refineries are being built here in the Middle East and the Gulf where I am, and of course in Asia. Is there any backtracking from that, do you think, in the future, or Europe has moved on? And also, just from a manufacturing point of view, demand, I mean, that ties into its whole economic outlook, doesn't it? If the economy is stagnating, then less reason perhaps to have that sort of immediate supply on your doorstep. Is the future of refining really increasingly away from Europe?
It should be the long-term trend. However, on the more short-term period, say the next 2-3 years, we might see a different dynamic regarding the European refining sector, with maybe less closure and more simply refineries changing hands. Just like the oil majors are still keen to get rid of some of their refineries in Europe because of the lack of demand, but margins have been so spectacular, so great recently, thanks to these closures already on the Atlantic Basin, that today it's quite profitable to run a refinery, right? So you would see some new players who might be interested to buy those refineries instead of closing them. So we may see less closures, more deals to sell refineries, but not to close them anymore, we feel.
Frederic Lasserre, Gunvor, Global Head of Research and Analysis. Thanks so much for joining us today on Halftime Talk. It's been great to have your thoughts.
Thank you very much. Thank you.